Weaker holding power will for sure be a theme for next year, and that's precisely what shook up the US market during the subprime crisis. You know what followed: defaults, a huge drop in prices, and eventually collapse of banking systems. Now, there are similarities in Canada right now, and that's why OSFI, Canada's big bank regulator, is trying to strengthen our banks to prevent a big catastrophe. Now, this video isn't here to scare you about next year, but really to let you understand a likely big theme for next year might actually be the increased difficulty in accessing capital, and this is something you need to keep in mind if you're thinking about snagging deals for next year. So in this video, let's dive into this topic. But before I continue, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. The Canadian and US monetary policies aren't all that different, and yet the effect of rising rates didn't hit Canada as hard during the subprime crisis, which did crash the US market. So what was different? Well, it all comes down to differences in lending. Between 2002 and 2005, when interest rates were extremely low, US borrowing rates were actually lower than Canada. By now, you're probably familiar with that scenario. When you combine cheap debt with real estate, people end up going on a big real estate shopping spree, and prices go up at an exponential rate. As housing prices grew faster, that attracted more attention, and so more people got in, resulting in higher leverage and more market speculation. And it got to a point where 12% of US mortgages had a loan-to-value ratio of over 90%, and this was double what Canada saw in the same period. And when they couldn't borrow from A lenders, they went to alternate lenders. And so in 2006, when subprime mortgages made up 5% of the market in Canada, they actually made up 20% of the market in the US. It also turns out that the price growth in the US doubled that of Canada between 2000 and 2006. So let's think about this. Prices doubled during that period, and yet the loan-to-value ratio was even higher in the US. And so they were way more stretched compared to Canada during that time. And so once rates started to rise, it didn't take too long to see cracks in the system, starting with higher mortgage delinquency rates, drops in property prices, and then mortgage defaults and foreclosures, and even bigger drops in property values after that, and eventually the collapse of entire banking systems. The end result was that prices had to fall enough for new buyers to find them affordable again. Most people in the US are on 30-year fixed mortgages, so a $300,000 mortgage at a 30-year fixed rate of 5.2% in the US is actually more or less equal to a $245,000 mortgage at a higher rate of 6.8% at a 30-year fixed rate. That's an 18% price drop that's needed, and that's actually exactly how much the US market actually dropped by at the bottom. The Canadian real estate market was spared then because our banking system wasn't nearly as relaxed. But it looks like we have gotten a lot more leveraged in Canada since then, which has sent our Canadian real estate prices up to #1 spot. In Canada, when rates were at the lowest during the pandemic, we actually saw a huge spike in variable mortgages, which took mortgage payments to very low levels for that period. And so if someone was just getting by then, they're actually now probably in a similar situation compared to many mortgage holders in the US in 2007. Now, you can crunch the numbers for what might be needed to bring prices back to affordable levels, but it's really not an exact science because markets often like to overshoot and undercorrect. But what we think is that the most vulnerable markets are probably those that overshot during the pandemic, like the lowest priced suburban homes if we're talking about the GTA, and these owners were most likely the most stretched, and that's why these properties are going to see the biggest declines. And so if you're looking to buy, yes, there can be some really great opportunities in the coming months, but you have to understand that next year's theme might actually end up being the difficulty in accessing capital, which might actually stop you in your tracks. Changes are happening already. OSFI is tightening capital requirements for our big banks to defend our banking systems, going from a 2.5% capital requirement to 3%. So basically, that's going to tighten up our lending. HELOC rules are also getting stricter, going from an 80% loan to value ratio to 65% by the end of 2023. Plus, property prices are just dropping too, and so there is less equity to be pulled out to refinance for new purchases. We're all experiencing higher living expenses, and that's also going to eat into how much we can save and use as capital for new purchases too. So all of this means that it will be a lot harder to buy real estate next year, even if you want to, even if interest rates stop going up, and even if the price is right. So if you do want to snag deals in the GTA in the coming months, it is important to get ready now. Consider gaining more sources of income to strengthen your holding power and borrowing power. You can also think about securing a HELOC right now before financing rules change later. It might also be a good time to think about restructuring your portfolio. For example, think about selling off properties in more vulnerable markets before prices drop even more in the coming months. This can free up your cash and improve your borrowing capacity, which will put you in a stronger buying position when you actually want to buy. And you can also use this opportunity to reposition yourself into stronger real estate markets with better cash flows and better long-term returns. And if you need help planning and figuring this out, just reach out to our team. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations, and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching, and see you in the next video.